Welcome to a special US edition of the Power Markets Livestream by Modo Energy. I'm Peter, and I'm joined here with Brant, and today we're going to take a look at the state of energy storage across ERCOT. The main topics that we're going to hit on today are looking at build-out through H1 2025 and what that can look like through the remainder of the year. Touch on best revenues as well through H1 25 and see how that compares to the previous last 3 years that the market has been maturing through. And lastly, we're going to take a look at where do we go from here, pulling insights from our recently released Nodal forecasting team to take a look at ATCs, TB2s, and some of our fundamental driving assumptions for the market. Lastly, we're going to round out with some product highlights and then transition to about a 10 to 15 minute time frame for Q&A. With that said, we do have our team behind the scenes filtering and answering questions as we go. So feel free to drop them in now or as they come up. Awesome. So kicking off, we're looking at the ERCOT market reaching 10 gigawatts of batteries in terms of rated capacity as of June 2025. That marks a nice milestone for the ERCOT market here that's been continuing to just about 2x over the last 3 years. A lot of what we've seen is the pace of deployment tends to pick up around Q2, Q3, and is relatively calmer in Q1, Q4. And ultimately, that's folks looking to energize in advance of those, high anticipatory June, July, August months. What you can also see from this is, a clear divergence between the rated power and the energy capacity. And a lot of this is being driven by sites that are not only getting larger in terms of their power, but longer duration in terms of their energy capacity. And this is further impacting the way in which batteries are impacting and getting revenues in this ERCOT market.
Yeah, and just kind of picking up on that thread, what we've got here is all the different batteries that are currently commercially operational throughout ERCOT. And we've kind of highlighted the batteries that were newly commissioned to begin commercial operations in Q2 of this year. So a couple of things that we want to highlight, kind of just picking up on one of the trends that Pete was just noticing, was the idea of more of these batteries becoming larger and larger in size. And so I actually want to highlight two ends of that spectrum, as that's really what's been kind of the key drivers of deployment here in the last few years. As we've noticed a kind of continued trend towards either the smaller side of sizes for rated power for a given battery energy storage system. So you can kind of see some of these individual smaller circles here, which represent those 9.9 megawatt and below size sites. Those are called distributed energy resource or distributed generation resources. One of the advantages of following that path is that you have a lot quicker time to get through the interconnection queue in ERCOT, and ultimately there's a little bit less regulatory oversight. But the flip side of that, as Pete mentioned, is that we've seen more of a movement towards larger and larger sites. So we're getting more of these 100, 200, even 300 megawatt sites now coming in line. And that's kind of led to kind of the decline of that 10 to 100 megawatt size site over the last couple of years. And that's kind of enabled that further doubling of total installed capacity that we've seen with each consecutive year. So, 2024, we saw total installed capacity go from around 4 to 8 gigawatts in ERCOT. And so far this year, we've gone from a little over 8 to, as Pete mentioned, just around 10 now, but we're expecting that to get towards 14 or 15 by the end of this year. Another trend to highlight here is that you can kind of see I've zoomed in on the Houston part of the map. As we've kind of seen a lot of development really start to pick up on the eastern side of ERCOT over the last year or two. That's something where, if you kind of think back to the beginning of development of both battery energy storage as well as intermittent generation here in Texas, a lot of that was led by development out in West Texas, kind of throughout the Permian Basin here, in far West Texas, and even as where a lot of the wind and solar generation was getting built throughout West Texas. And, as we've seen more of that solar deployment move across the state, we've started to see more of these batteries become sited in both the South Load Zone and really even getting into the Houston area here. The other thing to point out too is, following that, a lot of these resources are really kind of coming in as co-located resources rather than standalone batteries as well. And kind of to move over to our other map here. So same deal where it's just commercially operational batteries in ERCOT as of today. But now what we've done is we've colored them by 1 hour and 2 hour duration bucket. So anything above 1.5 hours in duration is going to fall into that 2-hour duration resource bucket. And you can really notice that places where we've had more and more new development, there's kind of a larger trend towards those 2-hour duration resources, which kind of aligns with what we saw in that first slide, where as we've gone further along in time, we're getting towards, a larger divergence between energy capacity and rated power, ultimately signaling that we're seeing, more of a pickup towards that longer duration. Kind of switching gears a little bit here and moving towards what's going on in the actual interconnection queue. There's two key aspects to think about here in terms of attrition rates and how long you're actually spending in the queue. So how many projects are successful and how long do they take to get to commercial operations? What this chart is really looking at is how long do they take to get to commercial operations. So what we've done is we've taken the time a battery enters the queue. So a project that is having its project details tracked, essentially it's, completed or started a screening study, or it's started the full interconnection study process, all the way to the point at which ERCOT deems it fully approved for commercial operations, and measuring the time it took to get there. And basically the y-axis here is just measuring, is bucketing resources by what year they reached commercial operations in. And the key thing to note here is that we're seeing the timeline kind of start to shift towards being a little bit longer for projects that are actually reaching commercial operations and getting through the entire queue. So that's probably what we think is that's signifying a couple different key trends, which is the supply chain side of things and the actual time to get through the interconnection study process. So on that supply chain side, you're talking about delays in procuring transformers, procuring inverters, or whatever it might be. And then obviously the queue itself is becoming more and more competitive. We've gone from, just dozens of gigawatts or even less, as recently as 5 years ago, all the way to today where we've got over 150 gigawatts of battery energy storage capacity in the queue. So there's more competition with the various utilities to secure an interconnection agreement, ultimately to process those interconnection studies and to make it all the way through to commercial operations.
Yeah, that's great. I mean, and one way to take a look at what is in the realm of possible for kind of ERCOT and battery deployment across the region. What we're looking at here is kind of taking that 150 gigawatts that Brent had mentioned already in the queue and just applying historical attrition and throughput rates to that. So again, we'll compare and contrast this to what we see from our capacity expansion plan from our nodal forecast. But ultimately, based on the numbers we see today, the queue has the potential to support up to 50 gigawatts of BESS by 2030. Again, we're going to come in a little, or maybe 10 gigawatts shy of that as we get into the end of this decade. But certainly, as Brent said, a lot of people are positioning for those more early stage sites, trying to get past those interconnection studies and ultimately get through commercial due diligence here.
Yeah, right. So I guess just kind of round this off. This is, purely indicative of what we've seen historically in terms of how many projects have actually made it through the queue, how long it takes to get there. But as we were just kind of saying, we expect both of those things to kind of trend upwards over time in terms of how many projects are unsuccessful and are more on the speculative side of trying to get connected. And ultimately, we just saw that the time it's taking to get to commercial operations is getting a little longer over time here.
Great. So that's a look at where we are for build out for the first half of this year. What we're going to transition now is taking a deeper dive into what revenues have been and how that compares over the last several years. And so, this is a chart that we tend to lead with a lot here at Modo Energy Research. You can really see the way in which cumulative revenues across our Modo Energy BESS index. So that's, a capacity weighted index representative of what the whole BESS fleet is making on average. We're trending definitely a little bit lower than we've seen in the past 3 years. I think two things to point out on this, and again, we'll get in a little bit of the weeds on that later, is you're not really getting as much of an uplift in some of those shoulder seasons when a lot of thermal goes out for planned maintenance and operations. And we're not seeing the summer months, at least through our nowcast, right, which really tries to bridge that gap between the 60-day sched data delay and what we're seeing in the market really come through yet for July or August. Now, as we'll get into, location is everything, and there are obviously assets that perform way above and even below the median numbers here. But certainly location and ability to capture revenues are becoming more and more difficult and more important as this market matures.
Yeah, I think a couple of things that we're really going to pick at here are a lot of the volatility has been suppressed over the last 12 to 18 months, as we've moved, kind of, we'll get into it in the next slide or two here, but into getting away from ancillary services, the primary revenue driver, more into energy arbitrage and more storage resources that are participating in the energy markets. That's meant that, the idea of volatility, it's almost like a harder setup for the market to create, essentially, where it requires this, I guess, kind of a confluence of different factors, and you kind of require either extremely extreme weather, like kind of going beyond just the 100-degree weather days in Texas all the way to you need almost that 110-degree weather day on the summer side of things. So remains to be seen whether August will start to bring a little bit of that. Last year, a couple of the higher volatility days didn't happen until towards the end of August. So there's still room for that, of course, but yeah, we haven't quite seen it arise just yet. And then, putting some of that, I guess, kind of downward pressure over the last couple of years, kind of to tell the first part of that story, we'll look at the ancillary service side of things. So what this graph is showing here is the colored parts are going to be representative of the total amount of battery energy storage capacity that is being offered to provide a given service in a given hour of the day. And that's going to be the 7-day moving average going back to the beginning of last year, 2024. And then, yeah, we've kind of aggregated that up, not only across all batteries, but across all the different services. And obviously, you can kind of see that there's a big uptick as you can move through the development of more and more battery energy storage being operational in ERCOT throughout the course of last year, a big uptick towards the end of the summer, beginning of last fall. And the thing that we're kind of comparing that to here is how much ancillary service requirements is ERCOT kind of laying out on a given day for a given month. So essentially what we're trying to compare there is, how much volume is there actually available in these markets for batteries to kind of compete for? And the total volume is actually probably going to be not even probably, it's going to definitely be a little bit lower than these monthly values. And the reason for that is that, you have other technology types like non-controllable load resources that are going to be taking up around 60% of this RRS volume. And you have non-spin, basically resources that are only eligible to be able to provide non-spin, taking up some of that. So really this pool is effectively even smaller than than what this line represents. So yeah, ultimately all that to say is essentially, this pool of volume for ancillary services is relatively fixed. And we've seen, this rapid deployment of more and more battery energy storage over the last year and a half or so. And what that's translated to is, this opportunity to compete in that market is kind of getting competed away. And what we kind of refer back to it as and summarize it as is it's a saturation of these markets with battery energy storage systems. And so ultimately that's led to, a lot lower revenue opportunities in the ancillary service markets over the last year or so. And I guess that kind of transitions into this idea of what we've kind of been calling a phase 1 or phase 2, where we talk about moving from ancillary services being the primary revenue stream for battery energy storage and moving towards energy arbitrage being the primary revenue stream. So you can kind of see if we go back to that same timeline, the beginning of last year, early 2024, when we're over 80% of revenues were derived through ancillary service markets. And you can kind of see that following that same pattern as we got to the summer, towards the end of the summer last year, really starting to move towards more than 50% of revenues coming from the energy arbitrage side of things. So, buying low or selling high in the day ahead and real-time energy markets to the point where now, as we've gotten so far into the confirmed revenue periods through April of this year in 2025, you're getting towards, around 75% of revenues coming from energy arbitrage. And ultimately, yeah, that's kind of indicative of the similar trend that we saw on the ancillary service side of things, right? Where what this graph is trying to show is not only the total amount of capacity that battery energy storage systems are offering into the real-time market to provide energy, but also the price at which they're doing so. And so, two things are kind of changing here over time. Obviously, you're having a lot more capacity come into play. More and more batteries are being commissioned to operate commercially in ERCOT, and that's leading to just more capacity being offered under the system-wide offer cap of $5,000 per megawatt hour. But not only that, you're seeing a transition to more and more batteries offering that capacity at more and more competitive prices. So very similar trend to what we saw happening in the ancillary service side of things over the last year or two, has really started to emerge on the energy side of things. And that really plays into kind of suppressing some of that volatility. We kind of go back to the beginning of this revenue section that we've really started to see happen over the last year or so. So I guess kind of to sum all that up, really the way that I think about that happening is we go back to, say, the beginning of 2024, we're talking about around 15-20% of battery energy storage capacity that's being offered into the energy market on a day-to-day basis at a level below $250 per megawatt hour. And that's risen to, as we get towards closer to current day, we're talking about more like 30, 35, even 40%. And that's on a daily average. If you're looking at specifically the hours of the day and when batteries are more likely to discharge, like the evening solar ramp hours, say between 6 to 9 p.m., that proportion is even higher, right? Because that's when batteries want to get dispatched. They're offering to provide energy at a lower, more competitive price. So that means there's way more capacity, right? That's going to be offered at that competitive price, suppressing, or I guess limiting the ability of the market to have those really high price prints.
Yeah, and we don't have a chart for it, but I think, anecdotally, we're seeing the same thing on the charging side, right? So,
Yeah.
Batteries are offering, positive, not necessarily non-zero values to charge as well. And so a lot of this is, you might see higher gas prices, maybe higher peak load. You would expect a more kind of volatile market, but batteries are really kind of compressing that spread, as kind of Brent alluded to earlier, that push and pull of supply and demand really start to take shape here.
Yeah, absolutely.
I think, again, we can see this here, right? So we're saying lower year-to-date revenues following this limited volatility. We pointed it out earlier, but especially in the beginning of the time periods, this January, February, March, where a lot of folks would expect an uplift as those thermal plants come offline, as there's more or less headroom on the system to make available. We're just not seeing that much. And when you're getting 4 to 5x net output from battery storages at more competitive prices, it's clear to see why those price shapes are not materializing as they have in the past. I think also what's really important here is highlighting, again, the magnitude that energy arbitrage, whether it's in real time or day ahead, are really starting to crowd away, or I guess take over the competing revenue stack. And so, while batteries built in 22, 23, may have been done off the back of ancillary price forecasts, I think, anyone who's building an asset today or valuing an asset into the near future really needs to be focusing on that energy arb.
Yeah, absolutely. And yeah, kind of taking apart that last chart. So what we were showing there, of course, was kind of, again, that system-wide average of what the average battery energy storage system was making in terms of wholesale revenue in ERCOT. And now what we've got here is a representation of splitting across 1 hour and 2 hour duration resources, what every single individual operating battery in ERCOT is making in terms of actual earned captured revenues. So we've stuck a couple medians on here to kind of still be kind of representative of similarly what you would have just seen in that last chart, roughly where the average battery, or in this case, the median battery, is coming in terms of revenue. But what's really clear here, and kind of picking at the same thread of, a move towards energy arbitrage being the dominant revenue stream, there's a lot more variance in terms of how much revenue a given battery is able to capture, depending on primarily where you're located in the system. There's really two elements, right? And we'll get into it over the course of these next two slides, but the two pieces are, how much you're able to capture and what your revenue opportunity ultimately is at your node within the system. And so both of those things have a huge influence on ultimately where you're going to land within this chart. Because, obviously larger spreads mean you're going to have higher opportunity, and, different abilities of optimizers are going to mean that you're able to capture more or less of those different spreads. But yeah, key to note here that, among the top performing batteries here in terms of actual settled revenues, you have more of that revenue kind of coming from the energy arbitrage side of things, even a higher proportion than we saw in that the overall system average. And a lot of that has to do with those higher revenue opportunities, as we'll show on the next chart here. So yeah, kind of to get into that, this is what we're showing here is individual nodes that batteries exist at in ERCOT. And what we've done is taken the day-to-day spread opportunity in terms of spreads. So we're measuring the TB2 or the top and bottom 2 hour spread for every single node. And then we're stacking that up over the course of the first 6 months of this year so far. And what I guess a couple things to highlight here, I really enjoy this trip because I think it really tells a lot of the story of what the nuance of what's going on operationally in ERCOT, right? And why certain locations have different pricing dynamics than others. So obviously, I guess we can kind of start with West Texas, where there's a pretty huge variance in terms of the different spreads that different batteries are able to see. But not only that, the overall median spread that a battery that's located in load zone West sees relative to the other 3 load zones is generally quite a bit higher. And there's really 2 key reasons for that. So on the low end of prices, your trough, your minimum price on a given day, obviously you have quite a bit of solar generation, and that's located out in West Texas. That's kind of been the forefront of a lot of that installation over time. And then, there's not quite as much demand that's located in that part of the state. So, as you're going through the middle of the day, when you have a lot of customer demand that's in demand centers and along the I-35 corridor from Dallas down to San Antonio, as well as all the way to Houston, you're having to move all that solar power from the west part of the state to the east part of the state. And ultimately, that results in quite a bit of solar curtailment. And so that helps suppress that minimum price that batteries are seeing out in West Texas, where you're seeing some of that curtailment. Ultimately, prices at these different nodes are going to be suppressed relative to the rest of the system. And the flip side of that is that you've had quite a bit of industrial demand become developed over the years, especially out in the Permian Basin in far West Texas, where we've seen something like a doubling of demand growth in the last 5 years, all the way to the point where we're seeing 7, 8, 9 gigawatts on a daily basis in that part of the state. And that's ultimately raising your peak prices in the evening. It's a pretty interesting dynamic where you have, that trough that gets lowered by the additional solar. And then as the sun sets towards the end of the day, that part of the state actually becomes a net importer because you have these flatter demand profiles, and it can raise those peak prices. So you kind of get the best of both worlds for some of those resources. Again, the South Load Zone has quite a bit of variability as well, but has a bit of a flip side characteristic where there's quite a bit of wind generation down in South Texas, and you have some export constraints there. And the way that kind of wind generation is correlated against demand patterns and the way that prices are formed in ERCOT on a day-to-day basis, what you can end up having happen is on some days when wind is relatively high, but prices are also relatively high across the rest of the system, that you have some curtailment and ultimately suppression of prices down in like the Rio Grande Valley and far South Texas, which can kind of cap the top end of spreads for some batteries that are located down there. And I guess kind of to wrap all this up with the North and the Houston load zone, there's not quite as much variance within those zones themselves. There's really just not as much congestion within those zones. So you don't see quite as much of a variance between, the lowest battery and the highest battery in each of those given locations. But yeah, we're definitely going to be watching how that evolves over time as, we continue to move towards a more intermittent system and see how transmission development kind of continues to occur. And really to wrap everything up from a revenue perspective here, we wanted to kind of combine these last two slides, right? So what we've done is we took those settled revenues from 2 slides ago. We took the revenue opportunities from the previous slide, and we're looking at just the first 4 months of this year. So we can only work with the 60-day delayed data from ERCOT here. So we're working with January through April 2025. And essentially what we did was we took those settled revenues, divided them by the revenue opportunities to kind of come up with a capture rate statistic with one key difference from that last slide where we were only looking at the 2-hour spread potential for those individual battery nodes. But what we've done here instead is normalize essentially by the 1-hour spread or the 2-hour spread, depending on the duration of the battery at that node. So in this graph, a 1-hour duration battery is going to have its net revenue over the first 4 months of the year divided by its daily 1-hour revenue opportunities over the course of the first 4 months of the year to develop this capture rate stat. And the same thing, but for 2-hour batteries and 2-hour spreads. And ultimately, the thing that's, I think, really interesting about this chart is it goes back to the idea of high amount of variance, right? I think we're still in this kind of nascent stage of really getting through the idea of an energy arbitrage era or phase 2 of battery revenues as we see the market really start to mature here in ERCOT. But you have basically ranges of revenue capture all the way from nearly 100% of the TB1 or the TB2 spread on a day-to-day basis for some of these top earning batteries. But a lot of the individual batteries are really falling more in that 50 to 80%. Really, the median's probably in that 55, 65% range of their TBX revenue potential. And so I guess there's a couple things that speaks to, right? Is both, I think there's room for improvement, but also that revenue capture is really hard, right? It's hard to nail the real-time spread day to day. Volatility is obviously incredibly unpredictable. So yeah, I mean, I think it's going to be an interesting thing to kind of watch over the coming years in terms of how optimizers really try to continue to evolve their strategies to think about the idea that, prices in real time aren't necessarily peaking at the same time as when prices in day ahead peak anymore. And you have to account for the fact that, you have batteries running out of state of charge, and that can impact when prices end up peaking or end up not peaking. Or again, this kind of continued increasing competition that we were talking about a few slides ago also impacts this. Yeah, there's a lot to think about in the optimization challenge for sure.
Yeah, and I think not too surprising that they, capture rate is trending a little bit further down than we've seen in last year's, right? Like when you get less of the revenue stacking opportunity from the ancillary services, right? At the end of the day, yeah, we're measuring this against the TBX, but this is looking at net revenues across all products, right? That these batteries are participating in. And so, if you're getting less from that, it gets harder to actually outperform the TB2s that you have presented to,
Yeah,
or
absolutely.
TBXs, excuse me.
And I guess maybe one more thing before we move on to is the idea that, it's kind of funny to look at these, blank white bars here towards the right side in the sense that, you see the larger revenue potential. It obviously becomes harder and harder to capture as you have, these larger spreads day to day. And I think that's really indicative of the fact that when you have these really large spreads that are occurring, it's potentially more unpredictable volatility that's coming from kind of more localized congestion impacts that are closer to the node. And B, it's potential that, you kind of have to strike that dynamic of, are you going to be competing your own revenue opportunity away as you discharge your battery? Are there issues with the idea of over the course, if you have a congestion issue that's persistent over the course of an entire day, you might discharge your battery in the morning and capture a pretty solid spread. But at the same time, then the congestion persists and you run on a state of charge and you kind of can't necessarily do anything about that. So there's nuances to all these optimization challenges here. And yeah, definitely sympathetic to all the optimizers out there.
Great. So we're going to transition now into kind of where do we go from here? So really, this is going to be taking a look at the next decade out, leveraging the nodal energy forecast that we've been developing here at Modo Energy.
So I guess just kind of moving into some of the outputs of the model that we've developed here, just kind of help everybody run through a sense of kind of where we stand on the inputs and outputs, right? So we want to start by looking at around the clock prices here. We're looking at the horizon for our nodal forecast all the way through 2033. And to kind of tell the story of what we're seeing here, obviously starting back from a historicals perspective here in 2024 and 2025, we've had relatively low around the clock prices compared to the previous couple of years. That's kind of talking about some of that suppressed volatility over the last 12 to 18 months, and ultimately just more and more supply that's been built out in ERCOT. Not only is it suppressing the peaks of prices, but you've got tons and tons of solar that's come online in the system too, and that's helping bring some of those average prices, especially during the middle of the day, down. But one of the things that we're kind of seeing here is, obviously it's a pretty massive topic in ERCOT right now is the development of large loads, in particular on the AI data center or the oil and gas electrification side of things. And I think that's one of the things that we're expecting to see, that push-pull dynamic of supply demand continue to occur over the next few years and start to see demand kind of catch back up to supply, for lack of a better term, and potentially even outpace it at times over the next few years, which we're expecting kind of starts to bring up around the clock prices. Whether that's, I think we'd still expect that there's some lower prices during the middle part of the day, but you start to see some of those peak prices in the evening begin to rise, and even some of the overnight prices begin to rise a little bit as well when you don't have access to that solar generation, but you have some of these flatter demand profiles really starting to come into play and begin to impact things. As we get into the late 2020s, early 2030s, we're starting to see more of that supply starting to catch up again. We're starting to see the materialization of the Texas Energy Fund generation start to come into play as well, kind of beginning to capitalize on some of those higher overnight prices and higher peak prices in the evenings in conjunction with the continued development of battery energy storage systems in particular. And yeah, I think again, some of the counter to that too, as we get into the 2030s to kind of round out the story here of the nodal horizon, just being that we're kind of our expectation of, the U.S. continuing to become more and more of a net exporter of natural gas is going to potentially continue to provide an uplift to overall natural gas prices. And that would be, we'd anticipate that kind of continuing to help bring around the clock prices up into the 2030s.
Yep.
Yeah, and I mean, I guess on the TB side of things, I think it's a pretty similar story here in terms of what the overall macro factors are, and I think they correspond pretty well to our around the clock averages, really, because I think those are really heavily driven by that evening peak price period as well as that overnight period of time. I think the expectation would be that as you continue to add more and more solar generation, that middle of the day stays relatively consistent. I think the impact of batteries kind of eating into some of that will continue to fluctuate the middle of the day a little bit, but on the peak price side of things and really the top end of our spreads, it would be, I think, where we'd expect a lot of that movement to kind of coincide with the around the clocks. And yeah, I guess just one of the things to really highlight here when it comes to some of the key things to note between hubs and between zones is kind of tracking that evolution of the relative positioning of the different locations in Texas to each other. So I guess starting with West Texas here, the West Load Zone, our expectation is that that kind of coincides with what we've seen over the last few years. You know, there's lots of transmission projects that are going to be built out in West Texas, and chief among them kind of the Permian Basin Reliability Plan to continue to help supply some of that continued oil and gas electrification and some of those large loads that are going to be coming in that part of the state. But at the same time, you've got more and more solar generation, more and more batteries that are going to be built out there as well. And we'd expect that that kind of continues to mean that a lot of the same dynamics that exist today kind of continue to exist tomorrow. It's kind of, again, it's another one of those push-pull things where you build the transmission, but then the things that ultimately bring those higher spreads into play kind of still persist out into the future. And then switching gears into some of the other zones here, I wanted to highlight the fact that we see a lot of, again, similar trends that are bringing into play lower spreads in South Texas today. That kind of continues on into the future. And the one that I think is really interesting here is if we highlight Houston in red, kind of going from closer down to where we've got South Texas in terms of the day-to-day spreads as of today, towards the end of our nodal horizon here, where it rises up towards the West Load Zone in terms of spreads. And a big driver for that is, you know, a lot of those transmission projects that are being developed out in West Texas and to a lesser degree in the central and southern parts of the state aren't necessarily happening to the same degree as of yet in Houston. And I think our anticipation is while you're not necessarily going to have AI data centers going in Houston because of salinization concerns and things of that nature, but we're still expecting more industrial demand growth. You know, that natural gas exporting is going to continue to be a factor there, as well as just obviously increased consumer growth as more and more people are moving to the Houston area. So we're starting to see basically as we get into the 2030s a bit more of an import constraint developing there. And I think that starts to raise some of the spreads a little bit higher from what we were seeing, you know, back in that nodal revenue opportunity slide in terms of how it exists today.
Yeah, and I think along the same story and based on what we've been seeing over the last, 6, 12 months here in ERCOT, really the bulk of the revenue opportunities that batteries are going to be exposed to is from the energy arbitrage. So starting in 2026, we're expecting 65-70% of those. Again, this is at west load zone, kind of a typical 100 megawatt 2-hour duration. Of course, there's nuances at each nodal site that we would be forecasting, but for the bulk of it, it's really going to be contributing from energy arbitrage.
Yep.
There's a small portion coming from really that day ahead real time optimization that you can kind of trade virtually on top of that. And then really ancillary services are going down below sub 5% in the not too distant future. And this is probably a good opportunity to highlight, the revenue forecast, the kind of best forecasts that we do here are really grounded not only in the fundamentals, but indexed off of the Modo energy benchmark. And so, if you look at what 2025 is shaking up to be, I would say we're pretty on par for what this market is experiencing today.
Yeah, maybe one last thing to highlight here. If we think back to the ancillary service saturation slide that we talked through earlier, and that idea of the relatively fixed requirements that batteries have kind of had to compete for over the last 18 months, 2-3 years. So that's been relatively fixed since we got to post Winter Storm Uri and ERCOT increased its ancillary service procurement. But a couple things to note here on that front. I think a common thread that we definitely hear from people in the industry is the idea of over time, as demand grows and as you have a more and more intermittent system, there's maybe an expectation that the system operator starts to procure more and more ancillary services. And I think, I'm kind of two schools of thought on that, where, I definitely buy the intermittency angle in the sense that, as you have more and more of your generation coming from wind and solar, and it's ultimately your frequency is going to move around a little bit more. We've definitely seen more regulation deployed on a daily basis, on an hourly basis over the last few years than we were in the late 2010s, for instance. But ultimately, even if that leads to the system operator procuring more ancillary services, it's something that's probably more on the margin and just within that regulation service. We're talking about, at most 100 to 200 megawatts within given hours. And CAISO's gone through something similar here in the last couple of quarters. But compared to the scale of battery build out that we're expecting here over the next few years, it's relatively small, right? I think you're not really expecting that to make a big dent in the overall saturation of ancillary services as they exist today. And I guess kind of the second part of that discussion, right, would be the idea of, we have new ancillary service products coming into play, namely the dispatchable reliability reserve service, right? So That's still kind of in development in terms of what that's going to look like and which technology types are ultimately going to be eligible to provide that and the duration requirements of that service. But so I think there's two things to kind of note there, right? Where, anytime you have a new service, there's rollout challenges where there's a qualification period. There's a potential for a relatively short period of time, like we saw with ECRS, where the value to provide that service is elevated above some of the other services. But that quieted down quite quickly with ECRS. I would expect if something similar happens with DRRS to see the same thing kind of happen where it saturates relatively quickly. People are kind of anticipating this. They're going to be pretty well prepared. You're going to have people kind of getting online and getting qualified to provide that. So it's not something you can kind of build that entire investment case around, I guess is the long-winded answer here, right? So all that to say, yeah, I think any increasing volumes, whether it's from new services or from expansion of existing services, kind of pales in comparison to the amount of battery energy storage capacity that we're really expecting to see built in ERCOT over the next few years here, and all that. And again, yeah, it's something where the size of that increase in the markets doesn't necessarily correspond to the size of the increase in capacity available to provide those services, right? So it really squares with the idea of expecting over the longer term the minimization of ancillary services as a revenue stream for batteries.
Yep.
Yeah. And I guess kind of getting into more the input assumption side of things here. So kind of, having spent a little bit of time talking about where our forecast lands in terms of prices, revenue opportunities, and ultimately what that translates to in terms of a revenue stack for batteries, want to unpack some of the assumptions we're making on the input side of things. So, we talked about the push-pull dynamic of supply and demand kind of throughout this conversation, but really want to pick at the demand side of that here and how we kind of see that changing over the next few years. So obviously, this is a highly uncertain topic when it comes to ERCOT at this point. We've had numbers as high as 220 gigawatts in terms of peak demand in the early 2030s come out of the system operator here in the last few months. And that's obviously informed by utilizing, relatively speculative potential sources of demand that are coming on the TSB attested officer letter side of things. So what we've done here is we've tried to sort through a lot of that and just kind of construct our own bottom-up view and try to get an idea of what's actually truly feasible based on supply chain to potentially result in the build out of some of these large loads and ultimately increases to the customer demand side of things. So what this graph is showing, right, is our assumption for both peak and average demand over the next over the nodal forecast horizon through 2033. So, we can see that we're starting to get into peak demand cresting above 100 gigawatts by the early 2030s and average demand kind of sitting above 70 gigawatts in that same time frame. So a couple things to kind of pick at here. I'll start on the average demand side of things is, as we incorporate more and more of those large loads, those flatter demand profiles, that starts to raise the average demand relative to the peak demand. So you're getting more 24/7 demand profiles that they're consuming closer to their installed capacity rated throughout the middle of the night and things like that. That begins to be netted off by if they're bringing their own generation in the light of Senate Bill 6 or something like that too. But it's definitely much less of that traditional customer demand shape that you'd see with the traditional rising into the middle of the afternoon and falling overnight. And then one other thing to note here in terms of how this is formulated is that peak demand number that's represented here is actually net of behind the meter co-located generation for some of those large loads. So part of the distinction, part of the reason we make that distinction is in the light of Senate Bill 6, right? There's kind of an expectation we have at least is that some customers, that some of those data centers are going to be wanting to bring their own on-site power, right? The idea just being that you want to maintain that 99.999% or the 5 nines uptime and be able to potentially ride through even a firm load shed event, no matter how unlikely that event potentially is. So I think there's the potential for some campuses to ultimately have that silo configuration. I think it's ultimately going to depend on the customer. I know we've definitely heard from people in the market that there's other schools of thought too, where ultimately a firm load shed event is such an unlikely and rare event that I think they're willing to accept the potential limited downtime from something like that. But the idea just being that some of these campuses are going to be developed with on-site generation. And because they have that on-site generation, it'll net out their consumption on some days and in some hours. And ultimately, that means that what is seen as peak demand on a day-to-day basis for the grid is going to be a little bit lower than what it could have been without some of that on-site generation.
Yep. And then the last slide we're going to round out here from a forecasting perspective is taking a look at what our future view is and on installed capacity and ultimately the share of generation. I guess caveat here, this was all done pre-OBBA, and so we'll be updating these outlooks at the end of Q3 to reflect what that may do to primarily the near-term renewable development here. But what we're seeing is, as you can see on the left side, is kind of a slow decline and eventual kind of phasing out of the larger and older coal fleet that's currently in ERCOT. We start to see some of the nuclear facilities, as Brent mentioned earlier, from the Texas Energy Fund, really start to come through in the early 2030s. But primarily here, it's solar and wind that are taking the cake, and then batteries there really to shift that energy around to when it's needed most. If we were to kind of opine on what OBBA does to this type of build out, I think in our perspective, it's going to pull builds forward. We've seen what PTC and ITC cliffs have done to this industry in past, and we're pretty sure folks are going to move to qualify for that on an earlier basis. Um, you know, Brent was showing I guess the TB2 volatility across the various zones, right? For regions like the South where you have a lot of wind generation, what that might mean is maybe not new development, but an acceleration of requalification for PTC, so small little repowering efforts. And then, like we said, for solar, we still see that continue to develop not only in the West but in the Houston load zones.
Yeah, absolutely. And I guess kind of round everything off here, we wanted to kind of touch on some of what's been new here at Modo Energy. So like we've just kind of been going through in the last few slides here, the big one here, obviously just being that nodal forecasting is now live on the Modo Energy terminal. And so like Pete mentioned earlier, what that enables you to do is kind of develop unlimited forecast runs to be able to project battery energy storage revenues at a nodal level anywhere you so desire within the ERCOT system. So we've got currently 5,400 nodes, which kind of correspond to the various substations across ERCOT. So, pretty high granularity in terms of where you can actually site that battery. And it'll also allow you to customize, the specifications of an individual battery. So whether you're looking to do a smaller or a larger battery, kind of identify some of those sizing side of things in terms of, exactly what you want from a rated power and a duration perspective, whether you want to limit that battery's ability to cycle on an annual or a daily basis, the efficiency assumptions that you may or may not have, and yeah, ultimately anything you want in terms of customizing that run for one of those unlimited runs for storage revenues out to 2050. Kind of picking at a couple other things that we've been working on here at Modo. So over the last couple of months, couple of quarters, really, we've rolled out our U.S. research into more of the markets here in the U.S. So starting to cover not just ERCOT, but now we're covering pretty consistently CAISO, PJM, and New York ISO from a research perspective. And we're definitely not stopping there. The goal is really to have coast-to-coast ISO-wide coverage across, New York ISO, ISO New England, MISO, SPP by really the end of this year. And starting to dip our toes in the water of getting into the deregulated utilities as well as soon as possible. And then the last thing we wanted to highlight here is that we also now have TB metrics across the U.S. So, the way we really like to think about our kind of product development here at Modo is we kind of have research lead into our new regions, and that's kind of going hand in hand with, data discovery and understanding what the business case and revenue opportunity for grid scale storage in a given region ultimately looks like. And so one of the things that we've developed kind of in conjunction with that is to take power prices in any of these given regions. So we've got CAISO highlighted here, but this applies to any ISO you can think of in the US, and be able to measure, TB1s, TB2s, TB4s. So, same thing, those top and bottom spreads, measuring the difference between the highest hour and the lowest hour prices to really get a sense, a good proxy for what a battery energy storage system could hope to earn in the wholesale revenue space, within a given region. And I guess, we'll start to throw it over to the Q&A side of things now.
Yep. So we got a question here, right? So if the value of batteries stay low like 2025, do we expect a slowdown in development?
Yeah, right. I mean, I think the idea, I think if revenues stay relatively low, I think ultimately over time you'd start to see a higher and higher attrition rate in terms of what's in the queue today. You'd expect to see development probably begin to slow down. I think the assumption just being that, we are anticipating so much demand growth. There's only so much additional supply that can come from other types of dispatchable capacity, like your natural gas fired power plants and things like that. And if this demand growth is ultimately going to happen and ultimately manifest, that you're going to ultimately have more revenue opportunity that supports the continued development of more and more battery energy storage.
Yeah, and I think just to add on there, it's the other side of that equation is what's the CapEx? I
Yeah.
mean, certainly that will continue to evolve based on some of the new federal policies that we're still kind of debating and researching here at Modo. But ultimately, if we look at CapEx, what it was at the start of 2025, assuming, a reasonable amount of ITC could be claimed, you really only need about $100 per kW year to be looking at 15% plus, IRRs on a real basis. And so I think the economic case is certainly still there. And, I think something we've alluded to even earlier this year at conferences, location is
Yeah.
going to be really important. So leaning into kind of those origination teams, leaning into those transmission teams to find the right sites that can deliver that on a pretty kind of regular basis here.
Yeah, absolutely. That location point's really important. I mean, if we think about the revenue opportunities and the revenue capture slides that we were talking through earlier, I mean, yeah, for the majority of batteries and ERCOT revenues so far in 2025 have been, especially compared to the last few years, relatively low. But there are still batteries out there that are making a relatively high amount of revenue in terms of higher revenue opportunities and capture so far, even this year.
Great. Another question we have here, how much of an impact do you see the passing of OBBB having on BESS installations, even access to the ITC for storage system, right? It impacts solar and wind and a bunch of requirements. So I don't know if you have an initial view. I think we kind of touched on it loosely. Maybe I'll take the solar wind side again, but yeah, ultimately I think that accelerates repowering, it accelerates deployment. We're still waiting to see what start of construction means from a treasury perspective, and that may further tip the way that folks approach this market. But we do think it's going to pull forward a lot of those builds, and again, continue to provide that peak to trough at least for the next 10 years here, as before all that wind rolls off PTCs.
Yeah, I think on the battery side, it's honestly much the same. I mean, you don't necessarily have the same ITC sunsetting or investment tax credit sunsetting that the solar and wind resources are potentially facing, but you do have the foreign entity of concern restrictions that are kind of going to come into play here. And again, those are still relatively loosely defined. We don't fully understand what that's going to look like as of yet. But I think the idea is ultimately we would expect that same kind of playbook where you're going to want to end up accelerating the development of your project as much as possible. If you do feel strongly about the economics and you do ultimately want to proceed, that is probably going to be the outcome for a lot of people. So you might have kind of this rush and acceleration of development over the next couple of years, potentially a lull as we get towards the end of the 2020s and kind of the impacts of the bill really start to be felt. And then, I mean, there's, anything from a change in administration to, again, those continued shifting economics, either on the cost side or the revenue side, can really start to change things again.
A good question for you, Brent. Why is real-time market revenues beginning to outpace day-ahead market revenues? What's driving the shift in profitability?
Yeah, so I guess one thing I would say is really in ERCOT in particular, we have actually seen if you just look at specifically energy arbitrage, we have historically seen the majority of that coming on the real time side rather than the day ahead side. But there's a couple things to note there. I think you're right in that it's probably becoming more and more pronounced, and I think a lot of that has to do with one of the things if we think back to or if we look at actual spreads so far this year is that both real time and day ahead spreads on a day-to-day, hour-to-hour basis have actually declined so far in 2025 from their equivalent months in 2024. But day ahead spreads have actually declined further than real time spreads ultimately have. And I think part of the reason for that is, when volatility does show up, even if in the relatively muted sense that we've largely seen so far in 25, it tends to do so more in the real time markets, and congestion can really start to come into play a little bit more in real time, and you have forecast errors that really starts to come into play as well. And I guess the last component of that too is if you compare it to a market like CAISO where you have kind of actual bidding rules when if you do have a resource adequacy contract, you actually have to bid some capacity under a certain market price into the day ahead market, right? So that ultimately leads to way more of that capacity clearing in the day ahead market. Whereas in a market like ERCOT, you don't necessarily have those same restrictions. And so if on average your spread is going to be larger in the real time market, a lot of your capacity is probably going to end up going towards that versus the day ahead. Now, obviously, you still have people that are hedging between them. There's going to be days where that day ahead spread's a little larger, so you can't fully commit to one market or the other. But that definitely plays a large role for sure. I guess maybe the last thing to round that point off in terms of part of the reason for why those real-time spreads are bigger is not only on the top end, the congestion side of things, and the potential for ramp rates to cause volatility to come into play on the sub-hourly basis versus the hourly basis for day ahead, but even on the low side too, you have the offering from the wind and solar resources that is influenced by, in particular on the wind side, the PTCs. You have again congestion coming into play that pushes those minimum prices even lower than they go in the day ahead market. So yeah, ultimately it's a question of how big the spread is and comparing the markets.
Yeah, I mean, and maybe where I take that is it definitely creates a challenge for forecasting future revenues for battery. Whether you're a debt or an equity investor, a lot of times you don't like to be, fully exposed to the merchant tail. And so I think there's also a shift that we've been seeing on where folks are looking to lock that in, whether it's through getting tolling agreements, negotiate on on the rev share upside.
For sure.
And again, I think that's certainly one of the values we can bring here at Modo Energy. Let's see. Yes, you mentioned the queue has a potential to support 50 gigawatt plus at best, but is that feasible considering the saturation in market? What factor would increase feasibility?
Yeah, right. So I think that's definitely one of the threads we try to pick at throughout is that, in our forecast, for instance, we don't necessarily have 50 plus gigawatts of storage kind of coming into play by the early 2030s. We're more in that 40 to 45 gigawatt range by the end of kind of our nodal forecast horizon. And that's still quite a large increase in terms of total installed capacity, but there's quite a lot of underlying demand build out that's happening to kind of support that. So, right, we keep saying this idea of, demand kind of needs supply to meet it in this push-pull dynamic, right? But as you build more supply, that's kind of anticipation of more demand kind of coming into play, and that's really what's kind of played out over the last couple of years. Is there's an expectation that demand is going to continue to grow even faster than it already has been in ERCOT, and so the idea being that potentially you start to see. Right now, projects aren't making quite as much money as they were a few years ago. So maybe you see after the impacts of the OBBA, you see some development tailing off, and that coincides with the economics changing as demand really starts to kind of come into play and potentially provide some of that revenue opportunity uplift. So it's all a question of how much demand comes, what form it comes in, and how that compares to the ability for projects to get built from a supply chain, a CapEx perspective, all that kind of stuff.
Great. We're going to just take a couple more questions here before we close out the live stream. But why don't we go with this one, Brant? Why would West maintain higher TB2 spreads than Houston when storage development in the West is cheaper and easier than storage development in Houston?
Yeah, absolutely. I mean, again, I'm going to keep harping on it, but it's the idea of
Yeah.
there's other factors in play, right? It's not just that only more batteries are going to get built out in West Texas, right? It's the fact that, and even like things that you might expect to help decrease the spread, like the introduction of potential 765 kV transmission lines. That's another thing that should probably suppress the spread out in West Texas, right? But these things are in service of the continued evolution of these other variables, right? Where those are getting built because you have more solar installations that are coming into play in that part of the state. You have more of this, more of these large loads, a lot of these industrial loads, whether that's the AI data center scale, that side of things, where a lot of those are going to be sited in West Texas, or if it's the continued expansion and electrification of oil and gas production in the Permian Basin. Those things continue to happen, and these large infrastructure projects, whether it's a storage or a transmission side project, those are in service of those continued changes. So it's not necessarily always a straight line. Sometimes you're going to have a big up and a big down, right? But it's the expectation that these variables kind of continue to evolve, right? And so even though there's a lot more storage that's coming there, you have other changes that kind of support the continued installation of more and more storage and the revenue opportunities that support that.
Great. And then we'll round out with the last question here. In your projections, how does the introduction of real-time co-optimization impact AS revenues? I mean, I guess one thing to note is our model as it's built today is already co-optimizing across energy and ancillary services in real time. So kind of we're prepped for that change, and all of the TB2s and the ATCs that you've seen are reflective of that.
Yeah, but in terms of kind of how we really ultimately what we're expecting to come from RTC, right? is overall a more efficient market. And so that probably means lower around the clock average energy prices, right? Because you have the ability to effectively trade off, basically a resource that is going to be more valuable to provide energy is going to be used to provide energy rather than AS, and vice versa. So you don't necessarily have resources that are getting locked into the same day ahead commitments that you do today. And ultimately that results in lower average prices around the clock for energy in particular. The flip side of that, of course, is that that can potentially actually raise ancillary service prices to some degree because you're tethering them to real-time prices rather than day-ahead prices, right? So, we talked about the idea that real-time prices, at their absolute peaks tend to be more volatile and ultimately higher than day-ahead prices. And so, on these instances where you do have volatility in the real-time market, especially the volatility that didn't show up in the day-ahead, that can potentially cause, relative to the same scenario in a pre-RTC world, potential uplift to the ancillary service markets. But if you look at both the studies that ERCOT's done, and we actually did some analysis in house on kind of the impacts of RTC earlier this year, and ultimately the overall uplift to ancillary services is again it's relatively negligible relative to the again kind of continued saturation of those markets as you have more batteries and a relatively fixed pool of volume. It's only going to get more competitive in those markets, and it's not necessarily going to be offset by these small moments of uplift. While they are again, it's potential for again things at the margins, right? Where not similar to the idea of when you have a new product developed and potentially DRS over the next couple of years, there's pockets of potential opportunity there, but it's not something that you're building in the investment case off of.
Wonderful. Well, I think that about wraps it up for us here at Modo Energy. I'd like to thank everyone for joining, for Brant, and yeah, watch this space and reach out if you want to talk further about anything we've discussed today. Thank you, everyone.